And welcome to the Real Estate Show on KCMX News Media 880. Today, Pete Belcaster and Joe Brett, the real estate guys, with you here in the studio at KCMX. We're both real estate brokers with John L. Scott in Southern Oregon, and we get together with you once a week here on KCMX to talk about, well, all sorts of real estate related issues and topics. Over 400 shows we've done, and we've really never conquered real estate at all, because we still learn something every week from our guests. And that's why, of course, you're joining us here today, right? That's good. It's always good to know.
I think we've learned in our 10 years that it's a market that ever evolves, and you better learn, keep up with, and keep in touch with, because it moves fast.
Well, to talk about mortgage rates today, and we're going to invite Guy Giles, who's we call him our resident mortgage expert here on the Real Estate Show. He's been with us for some time, sitting over there. You look all decked out today, too, by the way.
You look good for radio.
You're right there. Anyway, I just wanted to show you, and I cut stuff out of newspapers, Guy, and it says here, long-term U.S. mortgage rates climbed. This was last week to their highest average in more than 4 years. The average of 4.46% for a 30%. For a 30-year fixed rate. So they are creeping up a little bit, but people shouldn't panic. Is that right? I don't want people to panic, right?
Definitely don't want to panic. It's still, even though they're up from those historic lows, they're still, believe it or not, historically low. I've been doing a lot of research over the last, week or so, just to try to put the whole thing into perspective. I rented out my house that I've had for 16 years, and I did just kind of tracked it for what I paid for it, what it's worth right now. And even through, the huge recession and the housing market crunch, I still averaged about 4.8% over those.
I guess it was 19 years. You're talking about the gain.
Yeah, gain on it.
Yeah.
So, when it's all said and done, it's still a good idea to go in and buy something. I thought my little $135,000 purchase price back then, when I wasn't making very much money, was a lot. But looking back, you kind of kill for that payment right now, even though, you have a little bit of appreciation in taxes going up about 3% per year. In the long run, I actually ran a scenario here for us today. If you were to buy your house now versus rent one.
And you talk right into that microphone there.
And I tracked it for about the last 9 years.
Yep.
Or, pardon me, for the next 9 years looking forward. And you'd probably be at about a $1,650 rent payment right now for a house like that. And if you had 20% down, your payment with your taxes and insurance, everything included, you'd probably be up to about $1,900 for your payment right now, which is a little bit more than the rent. But if you look at it at the end, just where rents are going up around here, its averages about 6% per year. At the end of those 9 years, you'd end up paying about $2,500 for rent. So you'd be,
you'd be way in the hole is what you're going to do.
Way in the hole, yeah. And your cash flow difference, per year would be about $22,000.
Well, I think with rents rising, and especially, as we talked last week for a moment about the issue of when Portland is coming our way in terms of landlords and what they're having to do, to secure, they're going to have to pay for people to move if you evict them and all sorts of things like that. And rents going up so high, Guy, and look at even in our own valleys here with people protesting some of this stuff and saying, hey, it's not attainable. So this gives you a chance.
It does, and like I said, we don't want to stretch anybody thin. We are lending right now to where we're looking at your debt to income ratios, but it's just not something you want to sit on the fence right now at all. Another piece of this that people don't really look at, your house is going to appreciate. And I accidentally didn't run the 9 years. I ran it up to 15, that $300,000 house. The forecast over the next 15 years is only about 3.4% is what they're thinking that it's going to be in this area. I have some pretty specific calculators. You're still, that house, you're up over $580,000 at the end of 15 years.
Yeah.
So, it's definitely worth doing it. Even after those 9 years, you have about $126,000 just in appreciation.
Well, there's lots of renters who need to look at that. There's renters all over the place, and they need to look at some of this because you're just taking that money and just kind of giving it to somebody else, and it's time to do that.
Yeah.
Especially if you're up in some of those huge rent increases in those big areas that we see, and if you're working, it's a difference also. And our economy is doing so well. And a lot of times, if you're renting, you've got programs you can beat. There is help. You can always overcome this, and you can actually be successful if you really want to.
Yeah, and I do believe there are more incentives coming, through the lenders because, I think the refinances are down to a 10-year low as far as that goes. And I have it written down somewhere here. I'm still not good at going back to my notes right
say that again. Refinances
are at about a
10-year
low
low
right
nationally.
now.
Really?
Yes. Yeah. If I remember right from this morning, and I apologize, it was kind of early. I believe it was about 38% of what's going on right now was refinances.
38%.
I've done a few this year, probably more than I have all last year. Because just right after the first of the year, everybody's feeling like they have some equity in their house and doing a few of them. But for the most part, I've been a purchase guy for years now.
Yeah, right.
But these rates, they are up some, definitely about a half a point since the beginning of the year.
Yeah.
So they are increasing. Definitely get to hold of your real estate agent and start this process if you're thinking about buying. Because I've had people from last year and the year before that were just a little bit uncomfortable with what they were seeing, and nothing compared to where they are right now. They come back and see me a year later, rates are up,
Well, there were a lot of us.
Prices are up.
And prices are up. Yeah.
Well, there were a lot of us who had, who still have variable rate mortgages, right? That adjust every 6 months. And how many years, Joe, did I get that benefit from that? For 10 years of that, and now it goes up. And it went up. It adjusted just this last month, and it went from 3.75 to 4.25, which was the highest jump of any time I've seen that in the last 15 years, which is not a good thing. So, is that a reason to finance guys to something like that? If you're in an adjustable rate like that and we're going up?
Well, you can bet that the Fed is they actually said it on Wednesday that they're going to raise it probably another 3 more times, and they did just raise it Thursday or Wednesday another quarter of a point.
Right. Oh, they did.
So,
okay. All right.
so it's going up, and I guess it would just depend on your long-term plans with the house. Historically, adjustable rate mortgages have always had a bad name, but they've generally always been, other than we've had a little inverted yield curve for a while, they've always been lower than the traditional one, just your regular 30-year fix. So it depends on your goals. I'm really leery to stick a first-time home buyer into a adjustable rate mortgage.
No,
it's not something
right,
that I ever really engage in, because everybody thinks, hey, I'm 25 years old and everything's going to keep going. It's been going since I got out of high school.
Yep.
They don't really have the.
Well, I think
it's a small study sample.
Yeah. I think you need to make that. You need to make that point again about that, because adjustable rate mortgages, as interest rates go up, they're going to look really attractive again, because you're going to start lower, right, for someone versus a fixed rate. And just say that again, because that's really important. People need to hear that.
Again, it just kind of comes down to your goals. If you're going to be in your house for 5 years or less, it might not be a bad option, but it's something that I really like to sit down with people and have the conversation. A lot of times people have the money or the means to pay off their loans, but they'd like the lower rate and they want to use the money for something else for a little while.
Yeah.
And, so it really depends on the circumstances. But if your goal, hey, I'm going to be, on this business track at work by then my wife's out of college and, we're going to be making this amount, there are definite circumstances. And you're right, it will become more attractive as rates go up.
Yeah. Well, okay.
And it'll be interesting to track the refinances, because just recently the equity has come back into these properties, into these longtime homeowners who have held on to their assets for a while. It'd be interesting to see if they exercise that option more, or are they just a little leery about getting deeper in debt, or unless they really have a pressing need, maybe.
Yeah, I always kind of start out with, especially when I'm talking to a refinance person, what's the most important thing to you about this, this whole transaction? And then you can kind of get to the nuts and bolts of why, if it's just literally, hey, I'm getting ready to retire and I need to be in, maybe they're in an ARM, or maybe they have a second mortgage that's adjustable.
Yeah.
All loans have a beginning and an end. So, a lot of these adjustable rate mortgages, once they get past that 10-year mark or whatever that is, they have to have an end date. So they'll have to re-amortize over maybe 20 years. So your rate has the potential to jump up a lot if you've been in one of those for a long time, even beyond just the little bit that the Fed raises up a little bit. It doesn't feel like it right now.
So by the way, we're talking with Guy Giles from Bank 34 Mortgage today on the Real Estate Show. And let me ask you, if I came to you, Monday and said I need a loan, what are the today I guess it is, whatever, but what are kind of you telling people this week? What are the ranges on the different loans that are out there right now?
Well,
it changes regularly. I mean,
regularly during the day.
Yeah.
I mean, today was some huge movement in the markets. there's just, to quote a rate, honestly, it's difficult to even be in ranges. We're around the mid fours. I mean, it depends. I have a manufactured house that had been moved twice for a veteran that I locked in. We're in the low fives just because of the situation.
Yeah.
I had another guy that in 8 months he's probably going to buy another house. So we kind of talked to him about, I'm almost paying for his loan just
Right.
to keep it so he doesn't really have any skin in the game if he decides to buy that new house a year from now. I don't want him to be $5,000 in debt with a mortgage to me. So there's all kinds of ways to adjust it, but I would say mid high fours is really where the rates are right now. I always try to give this one caveat though. If you get online and you're looking at these other home loan rates, I have a whole collection of the disclosures that have actually come out to the borrowers because they come to see me after they realize that even though it says no points, no fees, I don't know how they get through the compliance piece of this thing, but these things are turning up with a lot of junk fees on them. So if you're seeing them a lot lower than that, there's usually a catch.
Well, there's added fees everywhere, and people need to be aware of those things and ask questions about them because you got to be careful as you do this. Government program loans, the USDA's, the FHA's, how do the rates affect that at all, or do they even?
Well, they do. It's all gonna figure on how these things are trading. So they've all gone up about 0.5%. Today was one of these weird days where the conventional ones stayed pretty flat, and then the government ones got quite a bit worse. So it just depends on where people are putting their money, but you're still around the mid fours for the government stuff.
And I don't think that's probably it's probably going to go up a little bit more. I think through the year if they're going to raise it a couple more times. Boy, I hope they don't. I don't know what's the.
Yeah. It'll all come down to the economy. People are scared about these tariffs right now, saying that that's going to kind of stall the economy. I don't really think that's something that Trump plans on doing. I think it's just a plan to renegotiate NAFTA is what's behind this whole tariff thing. You know how he negotiates. He'll come out and say...
We're trying to get a show with the folks from Southern Oregon Regional Economic Development with us because the issue of the economy and jobs related to real estate is enormous, and when we have when people are employed, they're going to be able to buy, and this is what the millennials are doing. This is why there's jobs, why the economy is doing this. It just seems like it's going to continue for some time. I mean that's my guess. I don't know if it mean anything from it, but it certainly seems that way.
I feel the same way. There are jobs, and even though the rates are going up a little bit. The reason the rates are going up because the economy is doing really well, and stock market. People are making some money in that, but it's all going to come to our bottom lines. Inflation is inflation, but it's going to be wage inflation also. We haven't really seen it yet in the wages, but it's coming. And even though you're paying maybe a little bit more and a higher rate, I think overall everybody's really optimistic about where this economy is going.
Well, I certainly hope it stays like around that 5% rate, Joe, because if it goes up way above that, I think then all bets are off in terms of this. We've got a break coming up here in a couple of minutes. I'm curious if you've heard anything, with the tax cuts that went into effect regarding second homes, and you can only deduct up to $10,000 on the different kinds of things like this. Have you heard anybody that would come in to get loans? Have they talked about those things, or is that even under consideration by most people at this point?
Well, it hasn't really hit my radar that much here, to be honest. It's so rare to find somebody with taxes that are that high. I think they're moving here for different reasons. That could be part of it down in California in the really high cost areas. But what I'm actually seeing more of than anything right now is people escaping the fires.
You're still seeing that,
yeah,
right?
Yeah. There's a couple of them coming up this weekend to look at houses. They're pre-qualified with me, and again, you don't really want to build in the middle of a charred wasteland.
It's mudslides now too. The effects of those fires are continuing with the streams of rain that poured in this week.
Oh my gosh, yeah, it's. I think it's going to be pretty good for a while.
It's going to affect whatever happens in California. It affects us so many ways: the economy, housing, sales of this thing. It's not going to go away. And remember, we got to remember there's still 10,000 people a day retiring across this country. Just those are just the baby boomers, and you got the millennials.
About 2,500 are in California.
Yeah, and then you got the millennials, which is the biggest group of all underneath them now buying. So you've got pressure at the top and the bottom in terms of the age scale, and people are coming in and wanting properties right now. That's not going to go away. The demand for housing is probably what they're building. It's the type of housing that is being built is probably the weirdest thing of all here because it's kind of odd. We got a break coming up here. The Real Estate Show. We're with Giles from Bank 34 Mortgage. We're going to continue. We got lots more to talk about, including some new programs for you to understand also when we return after this. And welcome back to the Real Estate Show here on KCMX News Media 880. Pete Belcaster and Joe Brett, the Real Estate Guys, with you here today, and thanks for joining us. We're back with you next week. We'll talk about the economy and real estate and how they relate to each other. And got some terrific shows with renters. We got landlords coming up. We're going to talk about the rental market. It's just a lot of activity going on. And this is only spring. We haven't even really just got to spring. It's just now here,
and it's
going to be busy.
It's time for a lot of buyers are out and about and really ready to get in the game and get out there and find in this tight inventory continuing. But it's a hard fought battle sometimes.
It's not the buyers. It's not the buyers.
The sellers can't go.
It's the sellers. If sellers have no place to go and things like this. And I thought last week we had an interesting discussion about, there's grants even available through RVAR, through Access, to let you stay in your home longer. Because if you're retiring, you've got no place to go. And that's the alternative, the aging in place. And that's why the alternative housing issue needs to be talked about, because we keep building 3 and 2s, but that's not what a lot of people want. Yeah. And there's money to be made out there. I think there's got to be money to be made out there.
With housing prices going up as they are, interest rates going up as they are, 3-2s are not going to be a viable, especially with new construction, for any of our new home buyers or young families that are just starting out with their first purchase.
We did a show a couple of weeks ago with Sean Maroney and Alex Aronson on tiny homes, the smaller 400 square foot homes. Look how busy he is and how much demand there would be. But who's going to be the first builder, the first somebody who's actually going to break through and do something different? Yeah. I can't wait to see that if it will happen in the next year or so. Okay, Giles, that was our soapbox at the moment.
But I'm on the same one.
Yeah, it's just there though. But it's just, what are we building and what is the demand? And boy, it's changing. We were just the 4 of us last week. We'd all, the way we grew up, it's so different than the way the millennial kids grew up. What are selling? You want to know what's really interesting? What sells in estate sales and what doesn't sell in estate sales? We'll tell you how people's tastes have changed, how we live differently today. We'll get Lance Landers back, and that'll just surprise you what's going on there. But we're talking loans today and mortgage interest rates. So what are you telling folks, guy, who come in to say, okay, I need a loan here. You got some new things that maybe people might want to take advantage of, because the biggest problem today is I can't do it. I don't want to make an offer contingent on my house selling,
right?
Because if I do, I don't have a very good position.
Yeah,
but yet so many offers are coming in contingent on something. They're contingent on something. Okay,
that was the phone call that I took right when I got in right before we started taping. Was, hey, what contingencies are there?
Yeah.
And thankfully for these guys, there aren't any on this one. But I do have a program that it's a cross collateralization loan where you can come in, and if you have equity in your house, we encumber both properties. And actually, I think I'm going to have the rep come at our next show, and I'll have him go dive really deep into this thing. But that was my second phone call since I got here, was somebody else asking me about this one, because she's going to look at a property tonight. She's older. She doesn't want to have to get out of her house right this minute, but that'll give her the ability to just kind of work her way into the new house. And again, write an offer without any contingencies. So we would encumber both houses. I'll just use some real basic numbers here. Say your house is worth $100,000 and you own, you only owe $25,000 on it. So you have 75% equity in it. You want to go buy this new house. We will appraise both properties and give you credit for the equity that's in your house for your down payment on the other one. You only have one loan. And when your house sells, you can just recast that loan and reamortize it. You can pay it down to, whatever you would have been at to begin with. So
okay. I'm trying to get my head around that. Okay. So give it to me. Explain that.
So basically, if you have a house, and maybe we'll just go even simpler. You own it free and clear, so you have lots of equity in it, but it's not sold yet.
Right.
So it's on the market. It's ready to go, but it's not sold.
Okay.
You find that house you fall in love with. Normally, you're doing what you said. You go down there.
I go make it contingent upon me selling my house. Right?
Yeah, and then you have all of these moving parts. You're hoping the deal closes, so yours can close, so your contingency can
anxiety
get
and stress levels are rising.
So what you do is you go in and you just qualify with the equity in your house. You have a lien on both properties. Once your house sells, they'll release the lien on your old one.
Okay.
Yeah, and you can pay this new one down. You don't have to, but you can pay it down to whatever, wherever you're comfortable.
Now, is there certain qualifications for something like that? Because I can think of a lot of clients that I have who that might be something, especially because we've lost properties in sales because it had to be contingent on something here and there.
Yeah,
I think we all have lost property. We've all lost sales on that. People have lost sales on that.
Yeah, I mean, they are going to look at your whole situation. So I mean, if you have taxes on this new house, which you would, they're going to have to hit you with the taxes. They're going to have to hit you with the bigger loan than you have right now. But most of these people, they're older people that have been in their house for a while. They have equity. They probably have a decent income. The couple that I've ran up against that I'm working on right now aren't going to have any problem at all. There's enough equity in their house. You can actually use the equity in your house for obviously the down payment, but you can use it for closing costs also. So
interesting.
Yeah,
That's
you don't
an
even have to come up with
interesting
that
thing.
separate.
Wow.
Again, that's why I think I'm going to dig a lot deeper, into it. I have a couple of pretty interesting programs.
Well, in a tight market like this, especially in the lower price ranges, so many people. I mean, these contingent offers are just trouble. Now, if it's contingent and you're in contract to sell your house, then that's a whole different story.
Yeah.
But if you're just going to go to make it contingent on selling it, you're in trouble. But this makes a lot of sense, though.
But a lot of buyers and a lot of sellers, to get the deal done right now, are realizing they got to accommodate each other, and there's
not down here. I'm still getting lots of offers down here, ranges. So you think? Well, anyway, whatever that is, I think it's a great way to look at this.
Yeah, I heard about the program a few years ago, and I was really excited when I figured out that I'd be able to actually do them myself. So I've got a couple of them starting up this week, and anyway, we'll feel our way through them. And
well, when you get those done, I'm sure be curious as to how that works and how that comes out, because that makes a lot of sense, especially if you have to make it contingent on and you have equity. I mean that's not a bad way of doing it at all.
That's a good bridge to the current market.
And it's actually
it's not some weird thing like you show me your income level, that kind of thing. I mean, you've got it right there.
Yeah, it is an improvement to the old bridge loans as far as that goes. Now, I'm not allowed to do it over state lines though. So if you're in California or something, which is a huge part of what we have going on, it doesn't work for that. But I'm seeing a lot of people just kind of moving around the area that it is fitting in for.
Well, I would say that would certainly fit. I think of a lot of people that particular type of program would fit. But we still have the problem, Joe, in terms of listings. We still are under 1,000 listings. And I was checking those SOMLS stats, and if we continue to sell more than we're new listings coming on, we're going to run out of houses pretty soon.
And more than we can build.
We're not building them fast enough, and so. That's a real concern. I mean, to me, that's probably the biggest dark cloud that's out there.
That again, it limits the seller's ability to take advantage of their position to be in, to be able to sell now. They're unsure where they're going to land, and the buyers are really having to kind of wait it out and strike a deal with those sellers because they're still in the position of leverage. I think in a seller's market when you look at the big picture.
These numbers that I was actually looking at today. It says, and they're more national, saying that housing inventory dropped 8.1% year over year.
So, inventory or nationally,
So it's literally the lowest number on record right now as a country.
Well, we have home ownership is up in the U.S. It has dropped for a number of years. It is now up again to 64.3%. Millennials are buying homes. We certainly see that. We certainly see that happening. We see lots at the other end. What's happening, Guy, up in the upper end, the higher end market, where you've always had to get,
What up with your jumbos?
Well, the jumbo loans. Are those still out there? Tell me, how do the interest rate affect that in terms of the luxury market?
A lot of times they're pretty close, especially if you have a good credit score. I've been really pleasantly surprised as I've been pricing a couple people out on those recently. Sadly for me, I keep talking to real estate agents, and it's like, "What are you doing today?" "Oh, I'm showing my cash buyer. I wish I could get him over to you, but then again, I don't wish it wasn't a cash buyer."
Yeah.
But I've actually seen quite a few people coming in paying cash lately. But as I've been pricing out the jumbo loans, they're really competitive. So
Really?
yeah. I mean, again,
Tell people how a jumbo loan works and when I would need a jumbo loan.
well, we did raise the limit up for what are called conforming loans. Conforming loans are what the government will allow Fannie Mae and Freddie Mac. It's a limit that they set on how much they will loan. And right now in this county, it's $453,100. Don't know if they were just drinking that night and came up with that weird number. I'm sure it came from someplace. But so any loan over that would be what's called a non-conforming loan or a jumbo loan. So that's just meaning that a bank is taking that on, Wells Fargo or somebody. I have about 7 different people that I look through, and it's funny when somebody has a really good credit score, I always have Wells just kind of jump up to the top. I guess they like good credit scores and big loans. So I end up blocking a bunch of people with them that are doing jumbo loans. But that's just one cool thing about me. I've been looking a lot at pricing and a lot of different things lately, and just the ability to look around to a whole bunch of different lenders. Even though I'm a bank, we have about $100 million of our own money that we lend out, so we do some lending portfolio ourselves. But just having the ability to look around a little bit, a lot of times you'll have some little sweet spot that's just this IndyMac or somebody that likes a low credit score and not a big down payment. So their pricing will be a ton better than somebody else.
Yeah.
So
it's nice to have that option to shop around and match what's right.
It is.
Well, remember, in our market, there's really 2 markets here. There's the market of $750,000 and above, and then there's the market below that. And they're 2 very different markets. There's no question that.
I'll be glad to see.
Although I saw a sale this last week of a couple $1 million plus properties that have sold, so they are moving. I think the interesting part coming up here is the number of cannabis grows that are on the market now, or large parcels that were bought in 2016, and I see large acreages that are coming on the market now.
Would those be rural residential properties that might have been purchased a little prematurely?
A little bit prematurely, a little bit overpriced.
Yeah.
And trying to get that price back for those is a little bit harder to do today than it was in 2016 before the green rush went through.
And the county regulations.
Yeah. So there's lots of different markets out there. The rural market is different, than the urban market in Medford and East is different than West, and Nashville is different than Eagle Point. So there's lots of different markets within our area as well. Grants Pass is a place that Joe says prices are leveling, coming more reality based from sellers, even though it's a hot market.
Yeah,
a lot of demand.
I've had buyers pre-qualified for 280 up there, looking for a 3.2, and all the ones that they saw back even December, January were up in the 320s. And we watched those steadily come down now under 300. You get up above about 260 or 275 for sure. There's a spot there where there aren't a lot of buyers. The pool of buyers shrinks up a little bit there. And a lot of sellers below 350 are finding out that you're going to have to come back to find the market.
Well, but in South, everybody has to realize what's going on,
experience observation.
Well, that's the way it is too. But there's a lot going on out there, and again, but as long as we continue to sell more than we are being replaced with new listings, the market is going to continue to be it's going to be a seller's market, that's for sure. We got a break coming up here on the Real Estate Show. We're with Giles for Bank 34 Mortgage. We got one more break to go here today, talking about mortgage interest rates and their effect on the real estate market locally, and of course on each one of us too, depending on what you want to do: buy, sell, invest, or rent. We're coming right back to the Real Estate Show after this. And welcome back to the Real Estate Show here on KCMX News Media 880. Pete Belcaster and Joe Brett, the real estate guys, with you here today, and talking mortgage interest rates here in the last. This is not the last. This is not the last weekend of March. We got one more, May 31st.
For our viewers on our YouTube channel, Real Estate Show Oregon, Guy Giles has outdressed us today, and this is a new wrinkle with the video element now. I'm gonna have to pay attention to my fashion a little more. That's puts a different twist on
increases, we'll probably have to shower too. I don't know.
Anyway, it's all.
I had to shave and comb my hair last week. That was really not good for radio.
You can find these at realestateshoworegon.com is the website. We'll talk with Guy Giles today here on the Real Estate Show, and Guy, nationally, the National Association of Realtors here, 5-year appreciation in value across the country. In our state, 5-year value. If you're talking about people with more equity, more able to create more wealth for yourself, all that kind of thing in the last 5 years. Oregon, the average is 54%.
Wow.
54%.
Man.
Washington, 57%. California, 57%. Nevada, 66%. The average across the country was 37%.
Wow.
The average appreciation in value over 5 years. So think of us here. Most of us now are above water. Not everyone, but I see little pockets of neighborhoods and different streets around where people were bought homes when they were way too high and then went way underwater. They're just now getting back there. They're thrilled. They're thrilled over it.
Yeah. I think there's a lot of optimism all the way around from people buying, selling, getting their first house. I think the only ones that are tough is, if you are an older person on a fixed income or somebody that doesn't really have the ability to make more money. I have some people that do come in that they're dying for a small little house that they can buy. That's kind of what you guys talked about to begin with. Just, some builder to come in. I think they're talking about doing some incentives where I think the home builders are behind it, where they're doing a little excise tax or something, and that's going to help subsidize people that are doing multi-unit properties in town. I kind of feel, good and bad about that, but something's got to get done.
Well, there's movement around. Ashland has its new cottage housing ordinance that's in that is going to divide into small little places and small parcels. So we're seeing some changes and some movements.
But
it's not
fast
enough.
Additional dwelling units, and some infill that we're starting to take a look at
more
favorably.
You're talking about that in Medford,
right?
Yeah. And okay, look at Eagle Point out there. They're just Eagle Point. It has a lot of building going on out there because they have a lot of land inventory.
Right.
They brought in 2,000 some acres, back in the day. Yeah. And so they're just now beginning to use it, but they got more land than anybody does.
Yeah, I think the building definitely needed to happen around here. So hopefully that'll continue, and we won't make it so restrictive on the builders that they have incentive to keep going.
Well, Medford does. Medford goes and adds a tax on building again to pay for, what was it?
Affordable housing.
Affordable housing.
But
I love that.
But they're also looking at deferring systems development charges for developers until after sales are complete, so they're able to get projects done and not have to put that money out of their pocket ahead of time. They're trying to find ways, and they're looking. Bend is a city that is really kind of doing some innovative things,
right?
And thank goodness in Medford we're not trying to reinvent the wheel, but we're looking at other things that are effective communities our size and trying to implement some of those.
The developers here want subsidies. And we got to get the guy who you had on here, I don't know, 6 months ago, who did these affordable housing projects, for so much less.
And doing it without help.
And doing it without government assistance is just remarkable. And yet we're down here squabbling over the kinds of things. We're going to add this tax, we're going to do this, and we're not going to accomplish anything. We won't change anything until somebody somewhere along the line, I'm telling you guys, comes along and has some bold thing. It's going to tell a different kind of development than what we're seeing. We're not getting them yet. We're not getting them.
I think some innovation is long overdue. There's no reason, especially with the economy starting to do as well as it is. There's probably going to be a lot of people out there with money that they're willing to try to help. And I say we get the private sector more involved, and that's going to be the answer.
Yeah, and I agree with you. I agree with that. Absolutely.
The Housing Advisory Commission in Medford has developers, have people all across the board from the industry in the game at the table to try to kind of find ways that it's equitable for everybody to move forward, because we all realize that we have the need, and how do we accommodate that?
Well, I hope they put their money where their mouth is, really, and allow infills, to allow additional dwelling units, to allow tiny homes. And the biggest tragedy to me, seriously, is that nobody will loan on manufactured homes for seniors in parks.
Yeah, that's tough.
Nobody will loan on them. It's just I think it's bad.
Well, there are lenders that do it.
Well, but there's short-term lenders that charge you up teens of money, but they won't do it for a long term.
Well, if you're not going to take
You
advantage
see,
of older
that's
people,
the
you
problem.
can do it. Come on.
And by the way, the opinions expressed by Pete Belcastro on this program
That's true.
are
That's
exclusively those of Pete Belcastro on this program.
Yeah, well, that's true. Okay, listen to this one. In the first 3 months of this year, up through the middle of March anyway, in Jackson and Josephine counties, there were 28% more pendings than there were a year ago. Okay, pending sales were up 28%, and new inventory at the same time was down 31%.
Wow.
From a year ago in the first 2.5 months of the
I could even do the math on that. That's not good.
That we were that way. That's not good.
No.
There's less than 1,000 properties for sale, and again, part of the problem I still think is seniors like me who live in a home who want to sell it can't do it because they have no place to go.
And you darn near, if you're looking for something under $200,000, you better be ready to pack up and move over to the hill to Klamath Falls. Klamath County is about the only place I consistently are seeing listings that are in that range of anything
You're
under
right,
200.
Joe. And people start looking here. They go to Josephine County.
Right.
Now they end up over to Klamath County because the housing prices are so different.
Yeah.
It's really true. And and we're all in this mess together. The bottom line is that for realtors and for lenders is that home ownership is still the number one way to create wealth for you and your family.
True.
And so being able to do that and to do it successfully, which is buy, sell, all the kinds of things that we talk about, it's got to be stable. And I hope that does continue. It's very interesting, Anyway, Guy, we're almost out of time here. What else you got for us? Lending. I know you're busy. You want people to come and see you. VA loans, veterans. You're into that as well.
I do love working with veterans.
I know
I've always got a few of those going on. Another thing that we're doing right now is I have a couple of these bank statement loans for self-employed people. So if you've got self-employed people out there that have not been able to qualify, I was actually talking to another lender that didn't have this program, and she's been trying to get this guy approved for a while. The guy, his receipts and the money going through his business account are crazy.
Yeah,
he owns
lots
his business.
Of people that way. Lots of people that way.
And it's actually a pretty simple, it's actually a pretty simple loan, and the rates are good on it, and you can get into a house as a self-employed person. Obviously a good credit score helps there too. But I mean, literally, I have a couple of my other one. They'll go down to like a 600 credit score, which is crazy.
Well, that's the biggest increase I think in jobs is people self-employed working out of their homes.
I just had a guy
that's
before I got here. He just started his business this year, so I said, "Come see me next year."
Come see me next year. And people have been doing that for some time, so don't think that you can't. Get a home, you get a loan because you're self-employed.
Right. Yeah, these bank statement loans are really where initially the stated loans came from, and they made sense for people that are self-employed. They just don't show it, but they earn the money, and I don't think we're going back to where we're making it sloppy for the rest of them.
No,
definitely for self-employed people. If you had somebody having trouble,
all right, for self-employed, and again, also Guy about the cross collateralization program, which is taking equity in your current home and helping you get without making it a contingent offer.
Very interesting.
That is really interesting. That's a really interesting loan. Good luck with that. And I hope I hope that works out for you. We're all out of time today, so we got to go. Guy Giles, you can check him out. You can find him on Google him, and he's at Bank 34 Mortgage. He's a great lender here in the Valley. That'll do it for the Real Estate Show here today. For Pete and Joe, have a great week, everybody. God bless you all. We'll talk to you next Saturday. Don't forget to check out any of our past shows, realestateshoworegon.com. Have a great week, everybody.
It's a wrapper. Good job, fellas.